All right, so you may have heard as the Fed speaks on monetary policy, they say the Fed was dovish or hawkish. If you're not familiar with dovish, be sure to watch the previous video or click the card right here and go check out that video. Now, a hawk refers to a financial advisor or policymaker who believes that monetary policy should maintain high interest rates, particularly to curb inflation. And man, we've been hearing a lot about inflation coming out of the pandemic and going into the pandemic. But a hawk wants to raise interest rates or maintain high interest rates to curb inflation. So you may think, why does high interest rates curb inflation? Well, basically, the more money that it costs to borrow to, buy something, the less attractive it will be for consumers to purchase it. So let me give you an example. There's just some things that people won't pay cash for, or at least the majority. Majority of people won't pay cash for a car. That's all going to be financed. So the lower the interest rates, the more of a car you could afford, I guess that's the way to say it. Or when you think about houses, that's another thing that the majority of Americans will not pay cash for a house. That's why they call it the American dream. It's just such a big thing to work towards. It's such a big purchase. It's most people's biggest purchase of their lifetime, and they have to finance it, majority of people. And so if the interest rates are low, your chances of being able to get a house or your dream house have increased because the payments on that house will be super low in a low interest rate environment. But in a high interest rate environment, your payments may double on that exact same house that was initially in reach on a low interest rate environment. And if the payments double, what normally has to happen is you either have to wait a little bit longer to get that house because you need to save up a bigger down payment so you can bring the note down, or you have to look at a smaller or a different house or potentially rent a little bit longer. And so basically that slows economic growth. But the Fed, when they're hawkish, isn't concerned with the economy growing. They're trying to slow it so that they can bring in price stability. And what does that mean? It means stopping people from paying $100,000, $200,000 over asking price for houses, stopping people from paying $2,000, $3,000, $4,000, $5,000, $10,000 over for a car. Because in that type of environment, when you really think about it, the gaps between the have and the have-nots just keep getting bigger and bigger and bigger. There's not a lot of people who could just continuously pay $5,000, $10,000, $20,000 over for a car or for a house for a long period of time. And then also, what does that mean for resale value if you were able to pay more for it just because your monthly payment would be low in a low interest rate environment versus what is the house really worth? And so the hawks want to raise those interest rates so that it can slow down people doing kind of some financially irresponsible things. If you really think about it, they're not really concerned with economic growth. Like I said, they're more concerned with bringing supply in balance with monetary policy. I guess that's the best way to put it. So hawks think high interest rates are good. They also know that sometimes that might mean it costs more money for a company to borrow, so they may not expand or they may lay employees off. But they believe that that's a good thing because those people will leave those jobs and fill in some of the lower paying jobs or even pick up a second job. And I guess the Fed thinks that's good for the economy because at the end of the day, we kind of need everybody. So if you ever hear that the Fed is hawkish, simply means that they think interest rates should go up because it's good for the economy.